What are the expectations and what really could spook the market or surprise the market? Let's discuss that with Tirthankar Patnaik, Director and Strategist. He represents the institutional research business for Religare Capital Markets. Tirthankar, good to have you back. Thank you for joining us. The widespread view on the street is that today's credit policy will be more like a no event, and on expected lines, Reserve Bank of India will increase repo rates and cut MSF rates.
Yes, that is correct. I mean, CPI numbers have been going up meaningfully. WPI has been going up for the last 3 months, so the street is probably within rights to expect a repo hike of about 25 basis points. And in line of the central banks coming off its emergency measures that they had taken in July, the street is also probably right in expecting that the MSF would be cut down by 25 basis points. Our view, however, is slightly to the contrary. While we maintain that the repo rates have to go up meaningfully before the fiscal is out, and we are targeting 25 to 50 basis points, we have a contra argument today. We believe that the central bank will go with the pause today. We believe that the repo hike in September was taken with keeping inflation numbers in mind. So the central bank has acted proactively rather than react to the numbers coming now. And by that metric, we are saying that the central bank will have the rate hike in December, not really now. And on the MSF, we believe that we will see a pause. And the reason for that is it will be a very wrong signal for the central bank to be sending when CPI is at 9.84% for September, and the October numbers would be marginally higher than that, actually reducing the MSF.
Tirthankar, hi, morning. Since your assumption is that it is going to be a status quo and pause day from the RBI this time around, do you think that will please the markets and we may see some relief run-up coming in?
Yes, that's not ruled out. As you rightly pointed out, almost the entire street is expecting the repo rates to go up, and the street is also expecting some relief on MSF. So if repo rates do not go up today, one cannot rule out a relief rally. However, the MSF is also factored in, and if the RBI maintains a pause on MSF, that will temper the rally a little bit. On the margin, if the events as you're pointing out happen, that there is a pause on the repo rates, then PSU banks will be one where there'll be a significant amount of positive sentiment.
Tirthankar, credit policy aside, do you think the key monitorable, at least for the moment, is not what Reserve Bank of India could do, should do, or will do? It is the general fabric of the market which is looking slightly weak. The big picture argument is supportive, numbers are strong, but benchmark indices are stalling a bit. They are looking rusty.
The reason they are looking rusty is because underlying growth remains weak. A number of positive factors have been pointed out over the last couple of weeks that have sought to justify the numbers north of 6,000 for the markets. Current account deficit has come off, rupee has stabilized. We are not looking at the taper now happening anytime this year. And by that metric, liquidity is likely to come in as well, and we have seen foreigners buying. For us, the flip side of the story is that what nobody is mentioning is growth. Growth numbers continue to remain weak. Underlying sentiments remain weak. If you see the RBI's macroeconomic and monetary development survey yesterday, they have panned down the growth estimates meaningfully from 5.7 to about 4.8% for FY14, and not just that, for FY15 as well. Numbers have been brought down to, I think, a 5-handle number from 6.5%. So clearly, to us, the macro remains weak, and that explains why the index numbers look rusty at the moment. We've been saying that unless there's a macro recovery, any high number would be always suspect, and the domestic guys, the retail individuals, will use that opportunity to sell, as we've been seeing in the markets really.
Tirthankar, right now the environment is supportive for IT. Valuations are not that stretched. Numbers have been strong, but even though things are looking interesting and appealing for IT stocks have corrected after numbers.
There's been a little bit of profit booking. You've seen TCS go up more than 30-35% between the two results, and clearly, nothing had happened in the company that warranted such a sharp move, other than what happened on the macro, basically on the INR. And and so people basically lapped up IT stocks. Right now, yes, there's been somewhat of profit booking, but as you pointed out, we would be basically buyers in IT from a long-term perspective. We have IT as a big overweight in our model portfolio. IT and pharma remain our overweights, and yes, short-term profit booking apart, IT would be a sector we'll be overweight in actually.
Tirthankar, how are you approaching consumer staples / FMCG now after what we've seen from Colgate, Unilever as well as ITC this earnings season?
Well, we have a sell on Hindustan Lever, and basically there are only very few stocks in the consumer staples sector that we kind of like. Britannia has been a long call for a couple of months now, and the stock has done very well. At the moment, while we have a buy, I think one would be booking profits, given the results are just around the corner probably. And overall, given the consumption story in India is likely to be a function of growth, and we are focusing on growth at 4.5% for FY14, we will not be overweight in this sector. In terms of segregation between urban and rural, we've been very clearly focused on rural growth, rural consumption in this year rather than urban consumption. So stocks like Nestle, stocks like Colgate, even HUL at this point are rich in our minds. In terms of stocks that we like, Britannia, Marico, Dabur. Also Dabur had a great quarter this time, just yesterday. So these are stocks that we have been pushing, and on the same theme, we have been pushing two-wheelers over four-wheelers. So that's one stock, one theme that we like. Bajaj and Hero Motors, both Hero Motors especially, and on the same rural consumption theme, Mahindra and Mahindra is one stock that we really like.
Tirthankar, but the urban related businesses are also not doing bad. Maruti came out with excellent set of numbers. The volume growth from Dabur was not that bad, and the kind of feelers we are getting from other urban consumer names like Nestle, they are not bad at all.
No, I'm expecting these numbers to come off going forward. Maruti, yes, I'll take your point. The company did very well. Against expectation of 10% margins, these guys showed 12% margins. Some part of it, yes, they have booked on numbers which were, the pricing was in Q1 rather than Q2, and clearly 0.57 to 0.60 does create a big difference, and they have been recording their exports at the Q2 numbers. Some of the gains will go off in Q3. 100 basis points of the margin, but they have taken an 80 basis point hike, which is definitely a positive. So on Maruti, we have rolled over our numbers. We have a buy. We value the stock at roughly 14 times 1 year forward. So at this point, we have a 15% upside. Our analyst has recently upgraded the stock. I take your point on urban consumption. Maruti seems to have done well, but overall, I would maintain that consumption will come off. First quarter GDP numbers were at 2.6%, and clearly there's a big urban-rural divide. And even on Maruti, right, 31% of their revenues are rural, and which is one portfolio which is growing at 20%. So there's a clear rural focus even on Maruti. So we maintain our theme on rural consumption over urban.
Tirthankar, a lot of market men are also bullish on NBFCs. Names like Mahindra Financials, Bajaj Finance, and the underlying thought here is that NBFCs will gain at the cost of banks, which currently are in no mood to lend to retail borrowers, as they are worried about the quality of their balance sheet.
I would not be a subscriber to that thesis. We like MMFSL, we like Bajaj Finance purely, as standalone stocks. That argument does not push the argument for NBFCs as a class, given that we see, top-down argument is very clear. Inflation remains fairly high, and interest rates in this fiscal are likely to go up and are likely to remain high well into the next fiscal until we see some closure on inflation right now. So NBFCs as an asset class we will not like. We like housing finance companies. We like standalone stories. MMFSL, auto finance business, very good penetration. Bajaj Finance also, from that perspective, not really as a class.
L&T also of late has been a marked outperformer. For those who are buying L&T at the current juncture, are they simply taking a leap of faith that things will turn around?
Maybe it's a bit early in the day. Infra is one sector where we have a comprehensive underweight. L&T is the only stock that we have been liking. We have a buy on the stock. Our analyst likes the stock, but that's the only stock in the entire sector. But raising L&T to neutral or overweight, can happen. That cannot be basically accompanied by any other stock in the sector. So in our opinion, L&T is, the results were all right, but order growth is something that L&T would have to look forward to. And unless order growth significantly improves going forward, and we don't expect that will happen, we would be cautious basically. So L&T only name in the infra space, but a bit too early in the game.
Tirthankar, always good chatting with you. Really appreciate you taking the time out and speaking with us.